Good morning, lads. How are we?
Awesome. Awesome. How are you?
Another day in paradise. Jack, what have you been up to?
I had a few things going on, so I've been busy buying a house. So I finally found one.
Yeah.
Yeah, so hopefully cooling off finishes today, so then we transfer the deposit. So that's been a new experience going through all of that.
We don't want you as the only one not stressed trying to meet mortgage repayments.
Yeah.
It's so exciting, Jack. Bloody awesome.
So, like, media room, cellar.
Yeah. Pool, spa,
Helipad.
parking, lift.
The carry will come,
Yeah.
young man. The carry will come.
Oh,
Oh, that's exciting. And how's Anna doing?
Anna's going well. So we've got the 20-week scan today. So her belly's growing like bigger and bigger. Excited to see the scan today because like at 20 weeks, it's a little baby, right? It's a little human inside the belly.
Yeah, little baby there with bald head.
Yeah. I hope he doesn't get my genes.
oh, come on, big fella. Jeez, your genes are pretty all right.
Yeah, calm down, Jason Stratham. I was going through some old episodes just to get a bit of content because I found a new platform finally that can upload video on a calendar basis. So I thought, right, let's spool up some stuff. I didn't recognize you in the early ones, Jack. It's like there's a small child here with like a rat on his head.
Oh man, I miss those days. I miss it so much.
But in hindsight now that I'm used to what you look like, you actually look like you were wearing a toupee back then.
Really?
Oh, Jack, when I see your profile picture on the website, it's like we desperately need a new photo.
Oh no, I keep saying that, but I've done nothing about it. Like I need to get a new photo. People don't recognize me when I connect on LinkedIn.
People wouldn't recognize you in the street.
Don, what about you? How's life after Libby's return to work?
We are adjusting. It's like nature finds a way. It's hit and miss in the mornings, but pretty good without my wonderful mother-in-law, Jan, who picks them up in the afternoon. We'd be in a whole lot of trouble. So here's to all the mother-in-laws. Without her, we'd be in a lot of trouble. And she also helped while I buggered off for 3 days and rode the Brisbane Valley Rail Trail last weekend, which was absolutely awesome. We've got to do it as a team.
Oh, I would love to do it. I've only done part of it. That would be awesome.
What about you, Aaron?
We went up to the sunny coast on Sunday. That was really nice. Had the kids up there and chillaxed on the beach. It's nice this time of year. I know it's cold and the water was pretty freezing, but it's invigorating. It was good value.
Free ice bath.
Yeah, it was really nice. Just felt really good to have the kids up there. And
you and Maren in your white cloth outfits, no doubt, running along the beach in the wind with that kind of.
Far from it. She's feeling the cold of the Brisbane winter compared to far north Queensland. So she's struggling, but adjusting. She's taking her cold showers to try to adjust faster. My 13-year-old has a girlfriend, which is the talk of the family at the moment. So lots of time giving dad advice on what not to do from my past experiences. But no.
Giving you advice or getting your advice?
You know what it's like with kids. Often they say and see things with much more clarity than we do.
Oh, that's scary. That comes around quick, doesn't it?
Yeah, very quick. Far out.
Let's jump in. So a couple of recap items. We had spoken a couple of times in previous episodes just around ESOPs and how the fine print can sort of get you. I'll edit this out, but Aaron, do you know that you have the world's loudest swallow?
So you know what? Peter Ellis would remind me of that every day.
And as the editor of this podcast, I need to formally ask you to go on mute.
Okay, I will.
You brought back bring up a bit of trauma.
Yeah, all sorts of trauma coming back now. Oh.
Anyway, so Dan Van Boom of Capital Brief brought out a new article talking about some of the challenges with ESOPs. And in this example, he talked about a situation where a Canva ex-employee had left on good terms. So a lot of the previous articles were about bad leaver clauses, where you've done something that the company doesn't like. In this, he was talking about how even good leavers can get caught, because what it said was he had spoken to an ex-employee of a reasonably prominent startup who discovered their contract's leaver clause locked the worth of their equity at fair market value on the date they left the company. The employee, who spoke on condition of anonymity because they still have equity at the startup, resigned on good terms. But they then sold a chunk of equity back to the company during a secondary sale a few years later. But it was only at about 50% of the prevailing rate because the value had been locked in on the date that they resigned. This is not a bad leaver clause. This was just in their good leaver clause. And so what they're highlighting is that the employee didn't realize that, didn't actually understand that was the case. In the back of their mind, you've done a number and this is what I'm going to get. Turns out they got half. Now, the article does point out that actually this isn't an uncommon situation, and even the template listed on the ATO website actually describes allowing the leaver to retain all or some of their options, but the transfer of the options will be at the fair market value as at the date of the trigger. And so I think we've got to be careful that this isn't companies going out of their way to be mean and Scrooge-like. This is employees understanding the reality of the situation.
Yeah, very standard terms. And for founders who haven't set up their ESOPs yet, there is a range, like there's some variables in there where you can choose to be more employee friendly or more company friendly, but yeah, pretty standard. Actually, I understand the logic behind that particular clause. Like you leave the company at that point in time at that value.
I can totally understand why this is the case. Like it's an incentive to keep employees at the company. But yeah, I'm surprised like a scale up like this doesn't have a general counsel that are actually really hand-holding employees and explaining this, because like you'd have no idea, and not a lot of people put the effort in to actually read the individual clauses.
I think that's true, but often with some of these rocket ship scale-ups, when early employees join, they're buying their own milk, they're organizing their own things. The equity probably isn't worth all that much yet, and so they sign up to these things. Then it becomes a rocket ship, and then it's like, oh, hang on, there's all these unintended consequences that I didn't realize because at the time I didn't put a lot of value on it.
Yeah, no, that's definitely fair. That's totally agree.
It is pretty set and forget. Like when I can't actually remember how we biased our terms, and we only set it up last year. I need to reread it.
Oh, good, excellent. That's Jack. I think you and I need to have a meeting and work out what.
We're transparent, Don. We're transparent.
Yeah. And then another. This is. I don't know what category to put this in, but we had previously talked about failure being baked into the system and needing to celebrate it a little bit. I saw this from Kathy Wood. So Kathy Wood, I guess, is the archetype for the whole COVID boom of just YOLOing into loss-making meme stocks. But she put, I think this is on Twitter, as a result of our trading-related capital tax losses, this should offset our trading-related capital gains for years to come. It's an underappreciated asset associated with our strategies.
Can you imagine saying that to our LPs?
So what you don't understand, LPs, is that we lose a lot of money. But if we make any money, it's an underappreciated aspect that'll offset the capital gain. Like,
you should be grateful for the tax offset.
Still conditional.
Like, she's got billions of dollars under management. It's just hard to work out what's comedy or what's not comedy. Now, in the world that we're in, because we do have a lot of failure, yes, if you have a loss, you can offset it. But I'm not sure we're getting to a point of marketing that as an underappreciated part of our strategy, are we?
The fact that she includes it with the word strategy. Whoa.
Maybe we're missing something. Speaking of capital gains, there was a post out from Kevin Jurovich that listed out Uber's first investors. So Oren Michaels put in 5,000, if held to today, 24 million. Jason Calacanis, his original check, 25,000, 124 million.
And that was gifted from Sequoia Capital as a finder's fee.
Yeah, it was a scouting fee.
How amazing is that?
That won't stop Jason claiming it as his most brilliant move ever.
Yeah. Garrett Champ, 220,000 invested. Today's value $1 billion. Now, the question becomes is how much of their stakes have they held? And that's not discussed and disclosed, but this is what early stage investors are seeking, are they not?
A 5,000 times return, if they held it through.
Now, the underappreciated part of it is the tax losses.
I was going to say, imagine if we had a few in there to offset it. Oh my.
So, and then it was just interesting. They put some details about the people. Like Oren Michaels was an entrepreneur who co-founded a software startup. Mike Walsh, who put in $5,000, was the founder of a business software startup. Joshua Spear, who put in 30,000, the blogger and brand strategist, is an angel investor.
And top of the list there, Garrett Camp. Like the columns show his investment of 220K becoming a bill. But then in the text, it describes his overall stake in Uber is estimated to be worth 3.7 billion. Not bad money.
Yeah. Now, I think a company that's going to have similar stories to this one day is Canva, the Aussie darling. But there was a AFR article by Tess Bennett saying Microsoft may have just become Canva's most dangerous rival. And the article says Australian design giant Canva faces a formidable new rival in its fight to win business customers ahead of highly anticipated IPO after Microsoft launched a new app that puts design tools in the hands of enterprise clients. Microsoft has made its AI-powered designer, we'll get to that name in a minute, available for free to all users on an iOS and Android. The Canva-like app allows users to edit photos, create images with the help of... Later on in the article, it says, the key question for Canva, is this the start of its Lotus 1-2-3 moment when Microsoft steamrolled a dominant competitor with its Office suite? Lotus Software created the popular spreadsheet back in the 80s that was then eventually overtaken by Excel. Zoom, too, has struggled to compete against Microsoft Teams, with businesses opting to buy a single package over individual tools. What are our thoughts?
I think for me, I'm not a fan of most Microsoft products, like Teams versus Zoom. I'm a Zoom person, and Outlook versus Gmail. And if you look at Skype, that was acquired by Microsoft. But there are enterprise customers who just embed off one product base, right? And they use Teams, they use the Microsoft stack, they don't want individual subscriptions like the article talks about.
The family office got pitched from Zoom an enterprise package. He then flicks it to me, and I'm like, actually, we decided, as painful as Teams is, it's integrated with OneDrive, it's integrated with all our systems. So across all of the business units, we've just gone Teams. And there's little things like shared docs, Microsoft Project we use on the property development side. Teams is a bit more shit than Zoom, but that ultimate user experience. And despite the Zoom guy trying to reduce pricing and say we've got all of these collaboration apps, I'm like, nah.
Yeah, I think for a certain stage of company, it makes sense. But this is where I think Canva moving into enterprise, that's going to be the interesting part for me. I don't know. It's one to watch. I don't know how it's going to play.
But they've done a wrap. They've done a wrap.
Yeah. Look, Microsoft did back in the day when they launched Windows. They were on the stage dancing.
I think we've got to separate, as this article does, enterprise from its non-enterprise.
Yeah, agree.
And the question becomes is, I don't think this Microsoft suite is going to be a threat to their, call it, non-enterprise customers, because as Jack has pointed out in the past, there's a switching cost of, you've got all your files there, you know how to use it, there's a comfort level, and just jumping across to something else isn't that easy. But from an enterprise environment, prior to the whole world coming to a grinding halt because of that CrowdStrike issue, if big enterprises are going to compare security and safety and all of that kind of jazz, you're probably going to go to Microsoft, aren't you?
Yeah, I would have thought so on the enterprise side. But even, okay, so as a casual user of Canva, I go in to create, sporadic items. It's not, to me, there's not really a switching cost because I don't really store things in there. Like each piece is a standalone artifact I'm essentially creating.
But how long did it take you to get familiar with the platform? Like that's actually the switching cost.
Yeah, but for me, it was like they're so good. It was pretty quick learning curve.
I do like the quote in the article. It's like, the market shouldn't underestimate Canva's scale over 12 years of product development. One
of the recent Harry Stebbings episode is actually Cameron from Canva. It's a really good episode. And the whole Canva team, when you listen, the confidence there is, the words come out in the most confident manner you've ever heard. But they've made acquisitions work really well. A lot of companies at their phase screw that up, but they've acquired a lot of little stuff that then they've been able to integrate. And that is a core competency. That is an operational excellence. It's not easy.
Yeah, that's a good point.
One of the things that we're finding is there's the horizontal solutions where a Microsoft will have a whole lot of generic things that you can use for a range of functions. But we're finding the world is going more and more vertical solutions for specific markets and specific industries. And the company HammerTech, which is a Melbourne company, which I must admit I had not heard of before, which is probably a bit of an embarrassment, has just completed a $105 million raise to a US private equity company. The Californian investment firm Riverwood Capital has backed the startup as it eyes off a larger slice of the US building market. That's a monster raise.
Huge raise. And I didn't know this company either, but it is a sector that we're starting to look at.
The article, this is in Startup Daily, says the platform tackles a range of building issues from onboarding and orientation to safety inspections to incident reporting and job site compliance. It plays in a similar space to 20-year-old Sydney unicorn SeenCulture, last valued at $2.7 billion.
And was it last week that we were talking about private equity coming into the early stage scale-up space? Like, this is an example, and it's a US-based private equity firm.
Yeah. And Jack, this morning you made some comments of what might be happening inside the likes of a SeenCulture with these verticals.
Yeah, like we've just seen a number of deals now that are all targeting the verticals that SeenCulture has owned. So I just would love to know, when they're going in a competitive tender, like what's the feedback the sales team are getting at SeenCulture? Like, are they losing out because they're just a pure play software checklist that's super generalist and doesn't go to the depth that these verticals need? I guess time will tell.
Yeah, because SeenCulture 20 years ago came to life when nothing existed, and then took very manual processes and allowed you to just generically create checklists, and then it started to add things. And SeenCulture is seen as trying to solve that problem for all industries. As we keep telling our founders, niching is important, not just because of product, but it's actually about messaging. If you've got two products and one's a generic product that can do the job, but with a number of workarounds, but it's not a specific workflow, versus someone that's sitting in front of you saying, we are tailored for your industry, all the messaging meets your industry, all the words, all the pictures, it's perfectly tailored to you, people are going to go to the latter option.
Yeah, absolutely. It's like we talk about when companies go into global markets, like that in these competitive spaces, the need to niche and develop a thick wrapper that is integrated into workflows and deeply integrated for that specific sector.
But I don't want to undersell SeenCulture. Like, they're a beast of a company, and I'm sure they've got a massive dev team. So if they were feeling the heat on the inside, I'm sure they'd be doubling down on their prime verticals and building out that platform to blow a lot of smaller competitors out of the park, or even acquire. Like, they're a big company now. But I think the takeaway for founders, like, even though you've got a unicorn in Australia, there are still so many opportunities in all these different verticals where you can build out a specialist vertical platform and go that 3 steps deeper than what is currently offered by SeenCulture.
And I think we had discussed it in some previous episodes, but it's one of the reasons why SeenCulture and Canva are adding other functionality to try and keep their users sticky, to try and compete with the likes of a Microsoft who's going the other way. They're trying to add almost vertical solutions to their generalist platform to keep their users sticky. It's this fight for eyeballs, fight for process to keep people within the ecosystem, because if someone has to leave to go and do something else, there's a risk you're going to lose them as a customer. Yeah,
I think the fintech innovation highlights this. Where you've got big income, big banks that are the generalists, the do-alls, but then particularly in the UK, you have thousands of very niched fintechs that are building massive businesses. Like Sterling Bank became Bank of the Year in the UK, but it was just incredibly focused on a particular customer segment, entirely digital experience. They didn't have their entire team were engineers, so engineers taking support calls. Like, the way they structured it was very innovative. Yeah, I think for founders, it's a really good lesson. Like niche, we say it all the time, and just be that thick wrapper.
And so, speaking of niche, that's also going for unicorn status, another raise spoken about in the media. This was again in Startup Daily. SeenCulture has raised $1 million. The software startup helps management make smarter, fairer, and faster decisions around employees for things such as promotions, performance, pay reviews, and team design. Founded in 2023 by psychologist Nikki Chigano, it currently serves more than 1,500 users and works with professional services firms, technology companies such as Atlassian and CultureAmp. Nikki actually came to one of our offsites and we got to spend a few days with her, and such a passionate founder.
Yeah, absolutely. And this is awesome. Awesome to read that Nikki's got this squared away.
I remember we were by the creek with the campfire going and talked about the why behind her business, and to learn her background and her story that led to this was, yeah, somebody that's really connected with the problem.
Yeah, and there's a fire there, right? Like there's an energy there to make this work. It just, yeah, you can see it in her, just that passion.
I'm actually catching up with Nikki not next week, the week after.
Awesome.
Just on Zoom to go through where she's up to, is just to see if we can be helpful.
Yeah, I mean, last time I saw her, second last time we caught up, yeah, she, shared some of the challenges of her cap raise as well. And it's not an easy journey at the best of times, but she had a particularly kind of tough battle with it too.
Yeah. Like if you hear from a founder who had an easy time with a cap raise, I don't know, they're a dirty liar. I don't know where to go with that. What I like about Nikki's product is she's building in virality and network effects really early. So with her product, what I really like is, in order to get a good view of this employee in terms of performance, team culture and team fit, the employee takes the initiative to invite 6 others, 3 above them, 3 below them. And then those people are asked to engage and rate different things so they can get a full picture. So if you think of network effects, if you've then got people going, oh, this is interesting, I'd like to understand this as well and be proactive, they then go and invite people. So I really like that aspect.
Yeah, I love it.
And Nikki's energy, and really all founders' energy that get over the hurdles that make it work, I think is related to this next article. Phil Morle of Main Sequence Ventures did a post called The Eye of the Tiger, which was a bit of a pain in the ass because as soon as I read it, for like 3 days, I've had the Eye of the Tiger. I'll see if I can break copyright and have that playing behind here. But Phil in this post said, I've learned to recognize the eye of the tiger in a founder. I've seen it many times in my work building companies. When founders start companies, anything's possible. There's an intoxicating sense of opportunity and optimism for a better world that the company can deliver. At this stage of a company's life, seeing the eye of the tiger is rare. Instead, we see curiosity, we see openness. The founder is hungry to learn and observe how the market responds. However, over time, burden accumulates. The founder builds a team, raises money from investors, both of whom they make promises to. They show them a world that they alone understood at one point and convince them to take a bet on their ability to bring it to life. They make early versions of the product and show them to customers. Likely they are a bit scrappy initially, but they mobilize the whole company to deliver the best possible experience. And the first customer loves it. But then, unless the founder's very lucky, something breaks, or a co-founder quits, or the technology doesn't work as predicted, or most commonly, the value promised when the money was first raised has not eventuated as hoped, and the end of the runway looms closer, while new capital is not receptive to funding a new round. When all hope is lost, feeling the weight of what they have promised on their shoulders, they get to work instead of giving up. These struggles can take months or years to resolve, but when the founders come through, they can see it. The eye of the tiger. It presents an unwavering look, a refusal to the resistance displayed by others. They have tested their own ability to do what it takes to deliver. Now they will not tolerate something in their way. They will barge through or root around. Either way, they're moving forward. This is the moment that founders are truly born. Thought that was 100%.
Absolutely. Phil's writing is always great, but I love this one. I think that there's a couple of parts to it for me. One is that impatience that you develop. Like once you've pushed through some shit and you've survived some shit, there is just a impatience and intolerance that comes from that. And then we talk about resilience. I think tied into this is that doing things you don't want to do. And that reminder that the more we lean into doing what we don't want to do, it develops that part of the brain that makes us more comfortable doing what we don't want to do. And I think for founders, you can actually develop that as a bit of a practice, like leaning into, well, for anyone, leaning into doing what you don't want to do more often.
Yeah, I just think like that's why team and culture are so important. Like if we talk about trying to find operational excellence, like it's so bloody hard to fight through the pain and suffering to get a successful outcome. And even if you have a great product in a great market, like it's inevitable that there's going to be tough times. So it always goes back to the founder and the team.
I think the other thing for me too is just because someone has been through adversity doesn't mean they've developed this eye of the tiger. Like there are some that, like, we could talk about all sorts of things, but yeah, I think just looking at a data set of did you survive adversity, that's not enough to actually identify this characteristic.
And as much as we tell founders and as much we know ourselves, it's always harder than you think. There's always things that get in the way. And for us, like, building a business, doesn't matter how many times you've done it, and it doesn't really matter what success you've had in the past, it is just hard. And even with where we're at, we're a small team trying to balance so many different plates. But this week really pushing hard, going, okay, actually a lot of LPs, a lot of investors are busy. We've got to start hitting the phones, which then meant reviewing the calendar, going, actually, cull that. We've got to knuckle down on this fundamental thing. And that has then led to some great conversations. But in this game, sending an email out for a great deal that you're really passionate about ain't going to cut it.
Yeah, 100%. Everyone's busy, and everyone's busier than ever. And you've got to push bloody hard.
I think the acceptance that it's like an ebb and flow, and you're going to get out of balance, and that's okay. It's then you recognize, and then you say, okay, now we've got to move to this next level. And even we haven't finalized any thoughts yet, but we've got to look at, now that the investor list is as big it is, we've got to look at how do we get some investor relations? How do we get some investor support? Is it just through distribution partners? Is it just through channel partners? Okay, fine to run an event each month. That's great. But what about the little touch points for people that can't come? Like, these are all the things that someone like us at this phase is trying to work its way through.
Yeah, 100%.
Now, on Phil's post, Paul McCarthy, do you remember we did an episode early on Paul's studies into entrepreneurs?
Oh, yes.
Some of the traits. Yeah, so that's the same Paul. He put a comment down the bottom. What Paul had done from his study, I think Paul's comment says his study looked at 21,000 startups worldwide, and he then found certain traits like the big 5 personality traits of successful startup founders. So openness, right? Adventurousness, right at the top. Agreeableness, extroversion, anxiety was high, anger, depression, and emotionality. So no wonder I'm pretty good at bloody entrepreneur. What was low, interestingly, was sympathy. And I think that does go back to one of our discussions last week, that actually some of the entrepreneurs that have achieved some of the big outcomes, they've actually got some pretty sharp edges.
Yeah.
I'll put the link to that study in there because that was quite good. And then they had teams that have a jack. High likelihood of success. These teams that have the right founders and execute well and get a little bit of luck and have the market opportunity, investors and founders are hoping to build a business that changes the world and creates legacy and passion. But it's nice to have some dollars along the way, and liquidity is a big area of discussion. And Airtree put out a post this week just to help founders understand liquidity and what are the options. And it's a table. And for the YouTube listeners, I'll share my screen. We're actually getting more and more people engaging on the YouTube version, which is good. So this little table, so the post says there's been lots of talk recently about secondaries, IPOs, and exits. So the 3 ways you get liquidity. For many founders, they feel like it's abstract concepts that you're years away from. But the reality is successful exits are years in the making. They start and end with good planning. So this table has exit liquidity pathway considerations. So across the top are the different types of liquidity. So a company-led secondary, then growth/pre-IPO round with secondaries attached, then an acquisition, so 50% to 100%, and then there's IPO. They then give examples like what Canva did, like company led the secondary, growth and pre-IPO round, like Employment Hero and Pet Circle. So the company raised some growth capital, but also the new investors bought from employees. Then the acquisition side is the likes of Uptick, Ready, Cloud Guru, where they actually sold the majority of their stakes, their company, to the acquirers. And then there's IPO, like SiteMinder and Atlassian. And so what it does is it just gives the examples, the summary, the liquidity potential for investors, the valuation to expect, what are the different sizes that you would need to be in order to pull that off, what your growth rates need to be, and how long it takes to execute. I just thought that was an interesting little table that I'll put in the show notes.
Yeah, it's really good to see. And chatting to a lot of first-time founders, I think I don't know, I find a lot of first-time founders talk about IPOs as the exit strategy. Yeah, this data reaffirms what we know, which is as an investor or as a founder, the chance for liquidity out of that is actually, I invested in something, it listed, and under the restraints, I couldn't get out, and the bloody thing collapsed before I got any capital back.
Look, the majority of things should not be on the ASX.
Yeah.
As at the early phase when you're in that growth. Imagine a teenager having everything exposed to the world, all the mistakes, all the different bits and pieces, still haven't got the predictability yet. Things that go to the public environment too early get into a lot of trouble.
Sounds like you just described my last 5 years, Don.
Yeah. Anytime a founder says, oh, I want to IPO this thing, I try and say, okay, let's find a couch, let's lay you down, and let's unpack all of the psychological issues that are driving this need for external validation, because IPO is really problematic until you get to a certain scale, which most of these companies are a decade off.
Yeah, absolutely.
I too have trauma around that. So
I actually think it's just naivety. Like founders just aren't aware that IPO isn't as common as a pathway as they actually originally think.
Yeah, I think there's truth in that.
Yeah.
Speaking of entrepreneurial activity, there was a post by Sav Pushparaja, who has been to our offsite. He's been on our London mission, absolute legend. But he did a post on the entrepreneurial activity on the Gold Coast, and it's actually amongst one of the highest in the world, which, having lived on the Gold Coast for 9 years, I was well aware of this stat. It is a very entrepreneurial community. 21% of adults on the Goldie have a registered business. That's not counting hobbies and other little side hustles. That's actually registered businesses. So 78,000 registered businesses, 49% of which provide professional or other services. And for me, this is super interesting because I think people move to the Goldie for lifestyle, or a lot of them do. And there's an association of entrepreneurship as giving autonomy, even though you escape the 9 to 5 just to work 24 hours a day. But it is, look, my view of the Goldie, there are a lot of kind of sole operators, consultants, service providers like the stats show. But it is interesting. I was looking at some data for Australia. Australia actually ranks 4th in the world for businesses per capita. So we outperform. But if you then drill into the data, a lot of it isn't really like how we might think of a business employing staff. A lot of it is like trust structures and other things. But yeah, Goldie, right up there.
Yeah, when we've held some events down there, and with the last mission, there were just companies that came out of the woodwork. It was just amazing to see what was being developed down there.
There's some phenomenal talent. And yeah, the ecosystem is interesting because it's fractured down the coast. And so it's hard to find some of the talent that actually exists there. But amazing business. Look at High Smile based out of the Goldie, Mick Dempsey, ex-Easy Debit based out of there. There's a lot of good entrepreneurial energy on the Gold Coast.
I'm definitely a big fan of the Gold Coast. Like I hope more of the tech industry move towards the coast, because the lifestyle and quality of life is so awesome.
Yeah, and the Goldie hosted an event, what was that, 2-3 weeks back? Bringing together 400 people from across the ecosystem down there to talk about how do we build on that ecosystem that's been developing. But it just ended up being a celebration of the local founders. Seeing Cake down there, Auto Guru, these guys that are just super passionate about what they're doing and super passionate about supporting the Gold Coast as well.
But it's like Boulder, Colorado, Aaron. Like, you don't have to be in the epicenter, Silicon Valley. You don't have to be in Sydney. You don't have to be in Brisbane. Like, the quality of life that the employees at Cake would have compared to someone who is just in Fortitude Valley, who then commutes on the bus, like, it's so different. And like the Cake team are doing yoga on the beach on a Friday morning. Like, it's such an amazing lifestyle.
Yeah, it's a good point. Like, in terms of attracting talent. And you're right, the analogy to somewhere like Boulder, yeah, you're spot on, Jack. Like, the culture is very different to being based somewhere else.
Well, it would be nice to get a tribe office down there at some point, although we've got a number of our GP shareholders down there and we swing in quite often. So let's get into some charts. Now, I warn you, this week's charts is the most disappointing in a long time. It's just really hard to find stuff when you're not wasting 6 hours a day thumbing through social media. But let's see where we can get. So this one, I thought this is a little bit interesting, especially because we've been talking about interest rates and recessions in the US. But this is the spend per capita change, average monthly spend March quarter 2024 compared to the same corresponding period in 2023. And on the left-hand side, it has age group, 18 to 24, 25 to 29, 30 to 34, all the way through to 75 plus. And in the essential categories, and it's pretty well the same for discretionary, the younger cohort is copying interest rate rises the worst because they're both essential spending and per capita spending on discretionary items is down, whereas the debt-free, high interest rate, cash earning boomer demographic, they're spending like it's...
That's interesting, isn't it?
So travel for the over 65 category is up 11%, whereas travel for the 25 to 29 is down 10%. General retail is up 9% for over 65s, down 10% for the under 29s. Eating out and food delivery is up for the over 65s, but it's by 7%. It's only up 2%. Utilities is up 4% for over 65s, is down 7% for the under 29s. So it's this, intergenerational differences of those sitting on cash and large property portfolios versus those that are still coming up the ranks.
I'm still, the measure of the economy by the Westfield Car Park Index. Like the shopping centre car park on the weekend was absolutely packed, and Chermside was absolutely packed. But I wonder how many are just wandering around and not spending, or not spending as much as they were before, I guess is the point of this one.
But the only people that aren't spending are the ones that have a mortgage. Like anyone under 30 who doesn't have a mortgage has all of this disposable income.
Is this you reflecting on your life you just signed up for?
Of the 100%.
So Jack, for the next 4 months, he's living life, and then good luck.
Yeah. So it's like, I reflecting back on it, it's like I never understood like the impact of interest rates on individuals because I never had a mortgage. But now I'm looking, it's like, fuck man, $400 a week rent is nothing. I'm looking back at these weekly mortgage repayments. Man, there goes the disposable income.
But Jack, you are the absolute, what's the word? Like you are living VC with the hockey stick. Like you're going rented, no kids, to kids in a mortgage in a few months. That is the ultimate VC rocket ship right there, baby.
Yeah. That's so true.
Just J-curved your life.
It was supposed to be up, Jack, not down.
That's one way to put it, Aaron.
Yeah, but we and the family office is part of the problem. Like we've got 11 things in front of council, DA applications across childcare, commercial property, retail, and council's flat out. Council's trying to find new people to help get approvals and things out, which then means the consultants are all flat out. The plumber that came this morning to quote on some renovation stuff, I said, how do you want to do this? Do you want to do fixed price or hourly? He said, I prefer hourly. I said, what do you run at? He says, $132 including GST. $132? He said, don't get turned off by the price. I'm not slow. I'm like, yeah, okay. New hot water system, $3,500.
What?
It's like, nah, man, I'm going to take the old one. When it dies, I'll get some wood burning underneath it. I'm going to teach these kids what it was like back in the day. The flywheel just continues. It's I guess why they call it an inflationary flywheel. And when we think things can't get more expensive, they do get more expensive because people with money continue to spend, and that money then flows through. And so, yeah, that's why I'm just not a big believer that we've got interest rate cuts coming anytime soon. I think we've got interest rate rises, if anything, because why the hell would anybody cut interest rates in this environment when property, services, construction, all of that shit is still going through the roof?
Yep.
Shifting gears a little bit, this chart was actually out of the UK. I've only put it in there because friend of tribe, Octopus Ventures, so this was shared by Ed, is actually now the 7th most active investor in the first half of 2024 in the European market.
Interesting. And Antler tops the list, which with their accelerator program that by volume, that makes a lot of sense because it's measuring deal count.
Antler invests in anything that moves, and if it's not moving, they kick it.
That's pretty fair.
Oh, it's a Y Combinator on this. I don't think I saved it. You know that cheese thing in the UK or Europe somewhere where they roll the cheese down the mountain and then everybody goes running after it? Someone did a meme of like, it's actually a YC Combinator startup, and then all the names of the different VCs trying to chase this cheese down the hill.
I haven't seen it.
This I'd added before that last one, but this is a visual representation, the impact of founder personalities on company success. So you'll see that openness was really high. Modesty is real low. And I think that's right. You find me a really modest founder, yeah, doesn't. Extroversion, really high, all the way to the right. Emotional stability, though, really low. I think that checks out. Anxiety, really, actually, no, the anxiety one, okay, this goes a little bit different to Paul's data. This is saying that they aren't anxious, whereas I actually think that a lot of founders underlying are anxious. Like I wake up with every morning.
I think, yeah, my kind of take on that actually, because that doesn't seem to correlate with what I would have thought. But then thinking about it, I think entrepreneurs, they're so used to anxiety, they're just accustomed to it, they probably don't report it as anxiety.
And then ability to build trust is high.
Trust and respect, baby. How much do we talk about that?
Then this is less a chart, more a little meme. There's two lines for the listeners at home. There's a sign that says hungry to win, and there's another sign that says hungry to do what winning requires. And there's a person taking orders underneath each of those signs, and everybody's standing under the hungry to win, but no one's standing under the hungry to win, but willing to do what requires. That's because Tribe's already been there, got its ticket and moved on.
Too busy out doing it.
Very disappointing charts section. I'll do better next week.
What are we looking forward to, boys?
I've got a good game of rugby this week, so we've got 2 games left and then finals. And Aaron, it occurred to me, it's not long till the wedding. It's 9 rugby sessions away. We've only got 9 trainings left till the grand final.
That's how you count your life.
I love how everything is a unit of measure of rugby.
Yeah, but far out. Like last night was out. We had 10 training sessions as of last night. I'm like, man, not long till Aaron gets married. Like that's.
Are you implying I should be like training for marriage?
No, you're fasting. Yeah.
I feel bad that I didn't RSVP on time and Marin had to follow up. But I think Marin's learning that the Australian culture is, if I can't come, I'll tell you.
Especially the Don McKenzie culture. Oh, shit.
I'm going to try and turn up on the right day too.
Oh, I can't wait. It's coming up super fast.
Super fast.
Other than that, though, what are we looking forward to, boys?
I've got a weekend at home, which is good. I've got a wedding here, my sister's, in a couple of months as well. So getting all that ready. Dad came over the other day. We were having a chat. He said, "Are you doing too much?" I'm like, "What are you talking about?"
Do you know who I am?
No. He said, "I just see a lot of machinery." I'm like, "Yeah." And my mower company's closed down, gone into liquidation.
I don't know how, with the amount of business you must be giving them. Maybe they've just retired rich.
I think they're sick of the stupid calls. It's like, "And what mower do you have?" Yellow one.
Oh,
yeah. No, looking forward to that.
Looking forward to jumping in the car this Arvo to go down. We've got an offsite with one of the portfolio companies.
Yeah.
Gold Coast Hinterland, so that'll be good.
Sweet. All right. Good. We'll see you next time.
See you guys.
See yous.